Bankers begging for mercy. That's right, folks. If you're wondering what part of the cycle are we in, where are we at on this timeline in this great reset, great financial crisis 2.0, where are we at? Well, we're at the part where the bankers are begging for forgiveness and begging for mercy from the central bank and Jerome Powell. That's right, folks. I'm going to show you guys a little article here from Bloomberg, and this is statements made by Gary Cohn, who is the former Trump economic advisor, and he's the ex-president of Goldman Sachs. So Gary Cohn says that the Fed hikes hurt banks more than they help the economy. And oh boy, I can't wait to get into this one. Because if you think that the Fed hikes have been helping the economy, I don't know what you've been smoking, but it must be some good stuff. The ex-Goldman president says that big banks don't need more capital, and the former Trump economic advisor thinks that Powell has done enough, i.e., Daddy Powell, please forgive us, let up on us, and give us just a little bit of mercy, please. So we have the former, and this is by Max Rays from Bloomberg, former Goldman Sachs President Gary Cohn, said the Federal Reserve needs to take a deep breath after rate hikes meant to fight inflation hurt the banking sector. I would like the Federal Reserve to stop, Cohn, a top economic advisor in the Trump White House, who is now vice chairman at the International Business Machines Corporation, said in an interview with Barry on Bloomberg Radio's Masters in Business podcast. Right now, in the tightening cycle, we've almost seen more damage in the regional banks than we have seen help for the U.S. economy. Now, I have to stop it right there. Where have we seen help for the U.S. economy based off of the Fed raising rates? Where has that provided any sort of help for our economy? It is not. It has caused mass layoffs and the cost of our debt service now going up nearly double from where we were at. How is that good or helping the economy in any sort of way? What are you talking about, right? Cohn said that this year's string of bank failures, which were sparked when higher interest rates eroded the value of long-dated assets and encouraged deposit flight, will motivate the Fed to increase capital requirements for the largest U.S. lenders, but he was skeptical of the benefits to that approach. Don't make us actually hold more money, more backing, more reserves. No, that's not the answer. Of course not. Because of what happened in the regional banks, we now have a Federal Reserve that thinks banks need more capital. So we're going to put more capital into the biggest banks. They don't need more capital. In a rate decision on Wednesday, the central bank kept its target for the federal funds rate unchanged at 5.25% to 5.5%. But Chair Jerome Powell signaled that another rate hike is likely this year. Uh-oh. Everyone's begging, Daddy Powell, please stop. Please let up on us. Cohn said that there has never been a period in which the Fed has been tightening monetary policy to rein in inflation, even as the federal government increases spending. He said the government initiatives, including the CHIPS Act and the infrastructure program, would create a continued labor market demand even as higher rates weighed on the housing market. If he had a chance to sit down with Powell, Cohn said he'd tell the following, I think you've done enough. Now, the truth of the matter is that he's nowhere close to done. He's nowhere close to cutting rates. I mean, it is expected that he will cut later this, next year, okay? But he is nowhere near winning the fight against inflation. He has not done enough. We have seen inflation bottom out. Now it's ticked back up for the last 2 months. The rate's growing back again from 3.2% to 3.7% just this last month. We're seeing inflation return. We got nowhere near the Fed's 2% target, right? And we have not done enough, right? The problem is that the Fed doesn't know how big of a beast it's created, right? We're still seeing the damage caused by Powell's Pandora's box getting opened up in 2020. I coined that term this last week. Powell's Pandora's box opened up in the simulation events of 2020, and we're still tracking the data, seeing just how bad this is, just how much damage they have caused by raising rates at the fastest pace in history. And before they did that, they cut rates to zero, and they increased their balance sheet, printed nearly a third of all U.S. dollars in circulation in a couple-year span, and we're still trying to figure out whether or not we're going to survive. We're not going to survive, and as I've been saying, you can pick your poison. Do you want death through default or death through inflation? Either way, we're done, okay? And it doesn't matter. The banksters can cry all they want, ask for sympathy, ask for forgiveness. no one feels bad for them, right? No one feels bad. The only reason why we're concerned is because we have money at these banks, and we have Janet no-telling Yellen basically saying that we have a full backstop for all the banks unless we determine that that bank's not really necessary. That bank's not systemically important. And then, yeah, we will let you fail. And the depositors are screwed if you have over the $250,000 FDIC insurance. And so this is the situation at hand. These are the type of Bloomberg articles, the headlines that I'm reading right now that just make me laugh. Cohn says that the Fed hikes hurt banks more than they help economy. Well, yeah, they do hurt the banks. And that's what happens when you guys went long bonds when they were at, basically 0.5%, 1%, 2%. And now we've actually had to come back to real rates. We've had to come back to, a real market. And if the free market was setting the interest rates, we'd probably be much higher than where we're at now, right? This is still an artificial market. We are in an artificial reality, right? You don't got to put on the meta goggles to enter the artificial reality. We're already in it when we're talking about our economy and what the Fed has created here. But where has the Fed hikes helped the economy? The only good job numbers that we have, most of them, nearly a third of them, are actually government jobs when you look at the data. And then a lot of them are just folks going to get a second and third job to pay the bills and make ends meet. This is not a strong economy. The Fed rate hikes have not helped the economy. The only thing that the Fed hike has done is it strengthened the dollar temporarily. So we saw the dollar get strengthened up until last year. That's why oil dropped down below $70 per barrel. That's why the CPI actually came down, is because we had a strong dollar, and that, the correlation to energy commodities like oil brought it down. But now we see a resurgence of oil shooting up 30% in the last 3 months, just as we're starting to see that CPI tick up once again. And so the Fed hasn't done enough. They're not going to do enough. We're going to lose this battle. And my expectation is that they are going to do a little bit of both. We're going to inflate our way out of this situation, and we're also going to write off a lot of debt. Biden's trying to forgive student loan. You don't got to pay on that. That's fine. That's obviously going to diminish our balance sheet because our student loan debt is one of the biggest assets on the United States government balance sheet. So if we forgive that, that doesn't help our balance sheet problem at all. It actually hurts it a lot. But you also have a combination of just money printing. And once again, it's being reported that the Treasury is set to start buying back bonds later this year or the beginning of next year. Now, they haven't done this in 2 decades. That's another form of quantitative easing. And what the Fed just did by the pause is a form of soft pivot. It's not a full pivot. We're not cutting rates yet, but just the pause alone shifts us in a new direction, and the market still rolled over even with the pause. I was giving Jerome Powell the credit that he had the backbone to do what it took and actually raised by another 25 basis points. He didn't. Him and the Fed, they went soft on us, and they gave us a pause, and the market still rolled over. And we perfectly called that Fed announcement, that bull trap rally that we got this last week for Bitcoin going up to 27,500, back down to 26.5. And we're just starting this correction. The broader economy, the broader stock market as a whole is still struggling to swallow this bitter pill that we're not going to continue on with funny money coming forever and good times for all. Participation trophies get handed out. And if you just say that you're simply going to leverage AI, your stock goes up. You're going to leverage metaverse, your stock goes up. That story's came and gone. And unless we get the full Fed pivot, I do not see a return to the bull market. I don't see the bulls having their day until we get that Fed pivot, until we start printing again, and then we start to see those asset prices go back up again. But who wants to take on any risk in the stock market, in real estate, in crypto, when you can go get risk-free yield of 4 and 5% from the U.S. Treasury bonds? And as long as we get that, you're going to see the regional banking crisis continue. You're going to see inflation continue. Okay. And you're going to see money leaving real estate, equity, and crypto. So be prepared. We got cash on the sidelines. We've been making our moves. And I hope that you guys are prepared to ride out this chaos. It ain't going anywhere. No matter how much we complain, no matter how much the banksters complain and beg for mercy, they ain't going to get it. At least not this year. And at best, they're going to get it later next year. And at best, you're still going to have rates being held higher for longer, which gives us that real estate reset, which gives us a correction in the equities markets, and which is draining liquidity out of the crypto space. Understand what's taking place. Don't just follow the hopium. Don't just follow the hype. Let's cut through the noise. Let's cut through the narratives. Let's cut through the bullish Bloomberg headlines that are absolute BS. And let's get to the real facts and how it's going to impact you on Main Street with your businesses and your investments. That's what I do, what I do. That's why I do what I do here. If you appreciate what we're doing, could you please smash it for me? Make sure you're subscribed, hit that notification bell, and you can get in touch with me over at my website, ZachRector.com. I appreciate all of you guys, and I will see you in the next one. God bless.